Okay, some additional information for not-for-profits. Okay, so where not-for-profit companies are having difficulty with meeting their tax and super obligations, ASIC has enabled some of them to defer their payments for up to 6 months. Once again, you want to check with ASIC as to what your criteria is required to meet that. But just be mindful that the board is still personally liable that payments are met. So it might not always be beneficial to defer payments. Just make sure that where you do that you are able to pay them. Charities that have to submit an annual information statement, they have been given an extension to 31 August, which will help some of them. Check the entity's constitution though with this, because there might be some wording that states you're required to complete it within a certain time frame. So just check that. Where you've got overseas partners, so say you're an organisation that provides, say, surgeries to help people's eyesight in a third world country, and you've got a overseas relationship with another company in that local country that provides all the surgeries, and they would provide regular reports to you either monthly. Have a look and see if they're able to still meet their reporting requirements, because that will have an impact on the audit, because that's something the auditor will look at when they test their cost of sales and their revenue. You also want to consider fundraising and the impact of fundraising. So there's a twofold impact here. For where money has already been committed to fundraising, what is done with that money, and where events specifically are fundraised for and those events can no longer occur, what options are those not-for-profits taking? Are they able to put it in a reserve? Do they have to return the money? The other factor is the ability to raise money. So are they considering alternate ways, such as online appeals? Are they aware of the fact that some grant providers are actually deferring and reducing grants, especially community grants? So when businesses are considering their forecasts, especially for JobKeeper and cash flow management, they need to consider these aspects. If they're relying on government grants or other grants, they might not necessarily be able to get that. So as the accountant, you really want to be reminding your clients just to be a bit more robust in considering the assumptions that they're making when they prepare cash flows. The other thing that is particularly good is governments who are a supplier to a business. So say you provide garden maintenance services to a government office or a council. The government is actually committing to paying within 5 business days any invoices that they receive. So if you've got any businesses that are in the industry that provides services to governments, then have the conversation with them to start issuing their invoices more promptly, because that will help them with their cash flow management as well. Where some entities and not-for-profits are reliant on volunteers, which is quite often the case, just something to be mindful of is, does their volunteer insurance cover pandemics? If not, how are they managing that? Are they even considering that? That's just another thing to just be mindful of. And where there are government grants that are issued, often these grants have conditions, milestones that are required to be achieved. Some of these milestones won't be able to due to business disruption. So you really want to be having that conversation with the grant bodies in advance and saying, you know, can I park this money in a reserve? If it's required to be spent by a certain date, can I get an extension on spending that? What is the impact of delaying or cancelling activities provided under the conditions of the grant? So these are just things to be mindful of that impact your clients, that you can just help prompt them and just get them to consider. Okay, so government subsidies. I'm pretty sure most of you already do this, but just in case, it's really important for any of your clients that prepare financial reports. And even if they don't actually, I'd say for all clients, it's really important that you have a separate general ledger code for each type of subsidy, mainly because they have different tax treatments. So JobKeeper is assessable ordinary income, grants is non-assessable income, and then the cash flow boost is non-assessable, non-exempt income. The other thing to also consider is how and when do you recognize the government subsidies, especially from a year-end cut-off perspective. So at 30 June, at what point do you take up the government subsidy? So most companies have a basis of preparation that is accruals. Where they have cash base, that's a little bit easier. So where it's an accruals basis, it is receivable once the employer has made the eligible payments to their employees, or where they have received notification for other types of grants and subsidies that the application for that grant or subsidy is successful. Then you would record a receivable and record the revenue. In terms of how you show that on your financials, where your clients do prepare financials, there are two different approaches, and it depends on whether you're a for-profit entity or a not-for-profit entity. If you're a for-profit entity, you can choose to record it as other income. Please note that you cannot, irrespective of whether you're for-profit or not-for-profit, you cannot record it as revenue. It has to be shown as a separate line item. For-profit entities do have the option of showing it as a reduction of wages, so netting it off wages. However, I strongly, strongly recommend not to do this, because it makes it really difficult then for your clients when they're trying to reconcile their BAS, their payment summary, and payroll. So it's best to just show it as other income. If you're a not-for-profit, you don't get the choice, you just show it as other income. Okay, some other considerations applicable for year-end for clients that do prepare financial statements. In particular, this would impact those that are preparing general purpose, although a lot of special purpose, no, it would be general purpose, especially for the first area. So deferred tax assets, they can only be recognized to the extent that it's probable that you're going to have future tax profits. Now, the two core issues that you have is, are the existing deferred tax assets justifiable? Now, if your entity is making a loss this year, then it's a higher level of uncertainty, especially if that loss is related to COVID. It makes it really difficult then to confidently say that you're going to have future profits. It's really hard to justify that it's probable. It pretty much needs to be almost certain that you can recover them if you're going to recognize them. So any of your clients who do take up tax effect accounting, they really need to reassess whether they have to write off that. It's going to be a lot harder to claim it, and you have to be able to justify it to your auditor if you do try and claim it. The other aspect is, can they be recognized? If you expect future profits, so even though you've made a loss, but you're fairly confident that you can have a future profit, then it's likely that it's going to be in the future that you're going to recoup those losses. So you're likely to have lower tax rates in the future. So one thing you could suggest to your clients is taking a more conservative approach, and you can use lower tax rates. That's something that we would probably be more inclined to consider, especially where it's not highly probable. Please note that if you're going to have cash flows, they need to be really robust, especially around this area. I'm just going to skim through the next bit because I don't think that's going to relate to most of your clients. So this is more if you've got joint ventures or associates, and once again, prepare general purpose accounts. If your joint venture associates have significant financial difficulty or a breach of contract, or they require support, you potentially have a contingent liability. So that's just something to be mindful of. And you also potentially have an impairment of that joint venture and associate. Okay. Once again, this relates to general purposes of accounts. It's not likely to be a major issue because this, once again, is a cut-off issue at 30th of June, but it's just something to be aware of. If there has been a lot of restructuring or there's restructuring currently occurring or termination of staff members, or where you are compensating your staff for working remotely, you potentially have a liability and an expense to take up, because if you have already communicated to your employees that there is going to be a restructuring and you've actually notified the employees that are impacted that they are going to lose their jobs, then you do need to take up at year end. If that's occurred pre-year end, you do need to take up a liability and a corresponding expense in relation to that. The auditor would want to see that you have actually communicated that to your employees, and so you need to see evidence. If, for example, you have got a business insurance that covers off on disruption to your business or business interruption, and you have lodged a claim for this insurance, irrespective of the outcome of the claim, you have the ability, once again, if you prepare general purpose accounts, to take up a contingent asset. So that's something to be mindful of. Okay, inventory. So quite a few clients will have inventory that is material, and they will be having the issue of how do they deal with stock takes. So this is where you could help them and be a bit proactive with getting them to think about it. So they can't not do a stock take. They have to do one for both financial reporting as well as tax purposes. So the factors that management need to be aware of is how are they going to actually conduct this stock take? Will it be done after hours? What happens if, are they going to actually have enough staff that are able to conduct it? How will they do it, enabling the social distancing? Where there are multiple branches, potentially in multiple states, it's not uncommon for somebody from head office or a manager to go and attend those stock takes at different branches just to make sure processes are working properly. How will they do that? Will they still be planning to fly, given the disruptions that are there? It's just something that they need to consider. Will the auditor be given access to attend the stock take if it's safe to do so? If they are not allowed access, then what alternatives are there? So one of the things that can be done is you could do a Zoom call between the warehouse staff and the auditor can go and make their selections, and they would just count it in the presence of the auditor virtually. They could also, although this is probably not as ideal, they could, if you've got adequate video security footage, you can, at least the auditor can be satisfied that the inventory exists from just looking at a security video, but ideally you want to be doing the Zoom meeting. So it's important that management consider these things before year end, especially because in the next couple of weeks they will most likely be having their stock takes. Management also need to document with those charged with governance, so their board, how they deal with all these factors. It's best if the auditors can't attend the stock take that they chat that in advance with auditors so that we can prepare alternate methods to test, because if we're unable to physically attend the premises and there aren't satisfactory alternative methods, it could mean that it's a scope limitation, which means that you might have a qualified audit. That might not be an issue for some companies, but for others where they have to report to like banks, it might not be something that they want. So it's just something to be mindful of. The other thing to consider is, when are you going to conduct your stock takes? So is it going to be early, so before year end, close to year end? What about doing it after year end? So after year end is available as an option, but you need to, as management, be pretty satisfied that you've got really good controls in place that can monitor from year end to the date of the stock take the movement in inventory. That's really, really important. So that they could also consider doing rolling stock takes. That's where every week or every day they would count a little bit of stock. A lot of clients, especially bigger companies, already do this. So just make sure that they've got good processes to document, and the audit can often rely on this information. Yeah, I think that's pretty much the key things around inventory from a stock take perspective. The other thing to consider for inventory is obsolete stock. There could be a lot of stock that's impacted from business disruptions, delays from suppliers, and management really want to consider if there is any stock that might be obsolete and write that off before year end. But if they're going to do that, they need to be able to justify it to the auditor. Also, if you're ordering your inventory from international suppliers, you could currently have the issue of a lot of foreign exchange variability. Have a chat to management to see if they're doing anything to try and mitigate it, like taking out foreign exchange contracts. Might be an option.